Well, the Treasury market is seeing its first back-to-back gain in a week as investors once again look to safe havens. But is there still appetite for Treasuries out there given the $115 billion worth of notes that are slated for auction this week? Our next guest, who correctly estimated the rise in the 10-year yield back in the spring, now says that the Treasury market is suffering from indigestion. Kevin Flanagan, fixed income strategist for Morgan Stanley Smith Barney, joins us now live from Purchase, New York. Good morning to you, Kevin. Indigestion, that's a creative way of characterizing it, but basically you're saying too much supply out there, not enough demand?
Yeah, essentially. You know, it was interesting. We went back earlier in July, and we had a 3, 10, and 30-year auction that went very well, much better than anticipated. But what was interesting, the auction amounts were kept the same. When we turned the calendar over to this week, we're finding out that the 2- and the 5-year auction were boosted by $2 billion, the 7-year by $1 billion. And so far in the first leg, we've seen some of that indigestion, that as the Treasury continues to increase in these increments, that demand from investors trails off, and we're going to have to see higher yield concessions, I think, going forward.
And so what's your trade around this right now? Are you staying short?
Yeah, you know, I still think from a fundamental backdrop, obviously the Fed isn't going to raise rates anytime soon, and they seem to be pounding the table with that theme of late. New York Fed President Dudley even mentioning it earlier this morning. So I like the 2- to 5-year area. But I think as we move further on, that you do get a sense when the Fed does begin to show signals they're going to tighten, that changes. But it would be premature right now, so we like the 2- to 5-year area.
Okay. Well, you believe, in looking at your notes here, you're forecasting a 4% yield on the 10-year by Christmas, by about the fourth quarter. Is that sort of your insight into the equity markets there in terms of more of an appetite for risk coming back, less of an interest in safe haven?
Yeah, I think that's what you're going to see. And it all depends, you know, this global recovery theme that we're starting to hear about. It does look like the recession ended in the second quarter. So if we continue to see improvement in economic numbers, the risk aversion trade, in other words, the flight to quality of Treasuries, will go by the boards. And you're going to combine that with continued supply challenges all the way through next fiscal year and probably the year after that. So, you know, I can envision the Treasury 10-year going to the 5 to 5.5 level by the end of 2010.
You know, there's a lot of talk when we see, like this morning we're under pressure, there's a lot of talk about that flight to quality trade. Is that still happening in a market under these conditions right now? How substantial of a pullback in equities do you have to see before that safety trade is really triggered?
I think if you know, something of consequence, not like a 1-day or a 2-day kind of trade. If you wanted to see something sustainable, I think, you know, you'd probably have to start seeing the Dow falling by a couple hundred points.
A couple hundred points.
Yeah, on a regular basis. In other words, you'd have to be down, say, 500 maybe from where we are now, and I think that would certainly catch everyone's attention.
So on a day like this, you wouldn't expect necessarily a sell-off in stocks to equal a move into Treasuries?
Not necessarily. I mean, you may see these little blips in terms of trading from stocks to bonds or something like that, but a sustainable trade, that's the key part. That I don't see happening in the near term.
All right. Thank you so much, Kevin Flanagan, fixed income strategist of Morgan Stanley Smith Barney. Thanks for joining us this morning.